Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with my good friend, Doug Heagren. Hey, Doug.
Here's to another happy Friday talking about the way all of the machinery works in the economy with you, Kirk.
There's a lot of machinery. I'm pretty sure most of it's broken, Doug. But
one big erector set, as if it was still installed and put together by my 10-year-old son.
I feel like it's more like Jenga. Let's see what this one does if I push this one out.
You might be right. We need a little spray glue in there to to rig it.
Yeah, that's a government's job. That's the government's job, Doug. That's what they do. They go in and rig the game for everyone else that's trying to do things like, oh, logically this should happen. Well, you don't know about the government's finger on the scale. I was watching Monty Python's Holy Grail last week, and there was the witch scene. She's a witch. She's a witch. She turned me into a newt. And they go through this whole logic thing, and they're like, so if she's the same weight as a duck, then she's a witch.
Yep.
Magically,
what else floats?
It balances.
Wood floats. What are witches made of? Wood. So therefore, if she's made of wood, she's a witch.
I always love the line, like, she turned me into a newt. I got better.
Fun fact, and I think I may have said this on another one, but fun fact that Monty Python Holy Grail would have never gotten off the ground if it had not been for George Harrison. He was a good friend, and he actually funded it. And they had no money, no takers, and he was a major investor. And thank goodness, who'd ever thought that George Harrison had a sense of humor? He was always seemed to be the stoic Beatle.
Right now, I would say very few people in our society have a sense of humor, Doug, or at least not in the cultural, in air quotes, cultural leadership. Right, the rest of us have humor, or at least I hope so. But the comedy has been lackluster in the last few years because people are afraid of telling jokes that'll get them canceled. And frankly, that's the point of jokes. They're to push boundaries. They always have been. Richard Pryor pushed boundaries. A lot of people pushed boundaries in the last, well, maybe not in the last 10 years, but, in the 70s, the 80s, 90s, a lot of people pushed boundaries. I mean, remember Andrew Dice Clay? I mean, that guy was outrageous. He only lasted for like a year or two because it got old quick. But, I mean, that was outrageous comedy at the time. That was crazy.
When we were kids in elementary school, what was really popular was a book series called Truly Tasteless Joke Books. I don't know if you remember that series.
I do.
I mean, that's what Andrew Dice Clay was basically a walking, reverberation of Truly Tasteless Joke Books. It wasn't sustainable, but man, he was a rocket ship when he came out.
Yeah. Yeah, he even got into one or two movies at the same time around that. It was
about as forgotten as I'm remembering them right now.
The Adventures of Ford Fairlane, Doug.
Oh, that's right.
It was a classic. I mean, it was a classic movie. It was, it wasn't great, but it was just like, all right, that's Dice. That's him in a nutshell.
Anyway. Another fun tidbit, because I'm all about segues and tidbit. Speaking of funny and comedy, Chris Farley. His cousin is the CEO of Ford. So there's the connection of Ford Fairlane and comedy and coming back around. But yes, I forget his first name, but yes, Farley is the CEO of Ford Motor Company, is Chris's cousin. And he's talked many times about what it was like growing up. And I guess they were pretty close. So being in the car with Chris and driving to and from places.
Be like Tommy Boy, right, in the car, that sort of thing.
And it's a perfect segue that his cousin now runs Ford Motor Company, and Tommy Boy is about the automotive industry. It's great. I mean, you can't script the way life comes together like that.
No, you can't. And it makes me think that we live in a simulation, Doug, not to go down that rabbit hole, but it's like life has a sense of humor, and you see things, you're like, that's got to be life playing tricks on us, because there's no way that's true. Like some of these people, like somebody made the joke, like, remember Jeffrey Toobin when he was caught on Zoom and at work? And it was like, you just got these names that are just like, that can't be his name.
Jeffrey Stupin on, never mind.
I mean, but other people come up with, they've got their names and you're like, that can't be that person's name. They got caught for some crime and that crime is in their name. Like, it's just like, how is that possible? Like, it's every once in a while life sends a curveball at you and you're just like, all right, you're just making fun of me now, aren't you?
Yeah. I mean, we could totally digress, but the world has an interesting cosmic connection. I was reading about a guy the other day that he was on a shipwreck, a major cruise liner, and he spent 70 years. He wouldn't go back on another ship until he finally decided that he was ready to go on a ship, and he ended up going on the Titanic. And because he felt that the reason that his decision was to go on that ship was that the Titanic was that when his first ship went down, they had no means of communication. He goes, we were using light signals. Nobody was responding. So the Titanic, I feel much safer because they've got the telegraph and we know that people will now respond to us. I mean, what are the odds? You wait 70 years to get back on the water and it's the Titanic. I mean, you're just death was just waiting. Listen, they say that the markets will be, would be more irrational, can be irrational longer than we can be patient. Nothing's more patient than death. Just saying.
There's one of my, and for those of you who are not aware of this, you definitely should be. There's a site called despair.com. It's been around since 99 because we found it. And it was hilarious because back then they had these posters you put on your wall called like motivational posters, right?
Yes.
It was like success, teamwork and all these things. This guy ran the opposite. They're called demotivational posters. They're absolutely hilarious. So if you haven't seen this, you have to go. And one of my favorites, I'm trying to find it so I don't misquote it, but if I do, I'll just paraphrase
Immaturity. It. The problem isn't that we look down on, oh shoot, I missed it. Yeah, they're great. They're incredible.
Yeah, there's one of them, and I'm going to try to pull it up here in the interest of time, but it's let's see if I can find it here. Here it is. Mistakes. And it's a picture of like a ship that's like looks like it's the Titanic, so it's like halfway underwater and halfway above, sticking up. It said, "It could be that the purpose of your life is to only serve as a warning to others."
There you go.
There's just brilliant humor for some of these, and some of these, like government. If you think our problems we create are bad, just wait till you see our solutions. One of my favorites is like two kids playing soccer, two like 5-year-old kids playing soccer. And I'm trying to see if I can find it. Oh, here's one. Here's another of my favorite. Potential. Not everybody gets to be an astronaut when they grow up. And it's a picture of McDonald's French fries. I mean, just absolutely brilliant. And and one of them was the two kids like fighting over playing soccer, and one kid's like straight arming the other kid in the face, and the picture says something along the lines of, sometimes it's a good idea to get out of the way of an aggressive kid in his dreams, or something like that. It's just, the pictures are just brilliant along with it. But anyway, if you haven't seen it, I won't read them all. Just go to the website and go through them all. They're absolutely hilarious.
Next Friday, Kirk, we're just going to spend an hour going through them.
It's funny. I teach a class to some advisors, and I teach some to like CPAs on the side, is just a way to like improve the industry, because I think both industries are drastically under mentored. So we do that on the side. And one of the things I do before every class is I bring up one of these and I talk about it, just to like open up the humor, because they're just so good. And
I'm going to leave the last one, retirement, since we're talking financial. Retirement, because you've given so much of yourself to the company that you don't have anything left we can use. And it shows a short, stubby pencil that's been ground down to the nub.
Oh, this is my favorite, and this is associated, and I'll wrap it up. Not to want to take the last word, but this is a good segue back into our podcast. Economics, the science of explaining tomorrow why the predictions you made yesterday didn't come true today. I mean, that just sums up economics in a nutshell. Anyway, off to real life here. So let's dive right in. I want to talk about a handful of things, and frankly, I don't have a great segue. I usually have a great segue for the intro into some mindset topic, but I really don't. So I'm just going to dive right into a few things. So the first one I want to get into is, we talked about 1 or 2 weeks ago about election year. and the probability of outcomes. And if you look at, I pulled up some of these stats for the listeners because at the time I was doing it off the cuff. So here are election year results, just for reference. So if you look at the 4-year cycle, 1 year after the election, so like the person gets elected the very next year, so it would be 2025 as an example, the average return is 4.7%. Now, the probability of a positive year is 56%. Now, year two, the average return is 2.3%. Obviously, a lot lower and not a great year. Traditionally, year two is a bad year for the markets. The probability of a positive year is 65%. Year three, average return is 11%. So that was last year. So that lines up with traditional numbers. That's the best returning year is the third year. Positive return probability is 88%. And then election year, which is this year, the average return is 7.4% and probability of a positive year of 83%. So that's the second best year. Now, the reason being typically is because when somebody is running again, they want to get reelected. And if somebody is in their second term, they want their party to get elected. So what happens? Well, they go all out spending. I mean, look what happened last year. The CHIPS Act. I can't remember 23 what acts passed, but typically they do a bunch of government spending and they do a bunch of things to appease their voters, make everyone feel good. So then the following 2 years, they can just do nothing like most politicians do. And then they back end it so that when they're getting reelected, they can look good. So you should just expect that the market knows this. And it doesn't mean they're going to have a lot of government spending. They probably will, let's be honest, it's the government. But the reality is that a lot of people base their investment decisions on probabilities and history. And because we can't know the future, but we can look at the past. So what a lot of people will do is they'll look at this and say, "Oh, I'm going to go all in because of the markets." Now that might be the right approach. I don't know because I can't tell the future either, any more than anyone listening to this call, or this podcast. But what I will say is, if you think about the probability of success, because you're hearing everywhere that things are expensive and we're due for a recession, and there's a lot of reasons for that, right? And one of the reasons, as we kind of pull it up here, I'm going to share the screen, and here we go. This is some things that Doug had shared. So if we look here, this is basically the S&P 500 stocks, all based on size. Size equals bigger square. So the tiny companies, you won't be able to see the names, but anyway, we just cribbed this from FinViz. This is PE ratios. So the more red, the more expensive the stock. The more green, the cheaper the stock. Now, what do you notice? Well, technology is way overpriced. Microsoft's 36.5 PE, which is really high. Apple's 29.5. Nvidia's 90. I don't know when you took this, Doug, but it's fluctuated between 50 and 200. So depending on the day, Intel's 110, AMD 320, Amazon's 58, Tesla's 43. I mean, those are crazy. Eli Lilly, 121. Merck is 959. That's probably due to other factors. But anyway, the point is you have a lot of really high numbers, but then you got some low numbers. Berkshire Hathaway's 11, JP Morgan's 10, almost 11. Wells Fargo's 10, ExxonMobil's 11.5. Can't see all the lower ones, but there are some lower ones. GM, Ford are cheaper. Some of the insurance companies are cheaper. But if you really look at these, what you'll notice is on the broad spectrum of a lot of areas, especially healthcare, especially technology, I guess, communication services really just the two big ones. The other ones are probably more reasonable, although Disney is trading pretty expensive. But if you look at a lot of the sectors, some sectors are fine, like energy's fine, and some are expensive. So if you look at that, and then you combine it with other factors, and I'm trying to find one of those other factors right now, but if you combine that with other factors, what you're going to realize is that the markets certainly could keep going higher. And we all think that when they're expensive, then they can't go higher. Well, they can, and they have consistently for decades. They're always going higher despite the fact that they're expensive. I mean, it's been happening since at least the past decade, maybe 15 years. So the PE ratio is not necessarily the best indicator. It's historically high. It doesn't mean it can't go higher, right? And I think you have to acknowledge that. That's the first step. Now, for reference, those of you who haven't listened to me before, I'm a value-oriented investor. I don't like high PEs. I don't like expensive stocks. It's not my nature. But I also acknowledge the fact that we've not been in a value environment for the last at least 15 out of the last 20 years, maybe 16 or 17. Value has not done well for the last 2 decades. There have been some years, but in general, it hasn't done well. So does that mean that we should get out of value? That's a good question, right? We've actually have a few guests on the show that are value investors, and it's a really good question. Has the market materially changed so that value is no longer a good investment? I don't know. I suspect that we actually hit a new paradigm, which we talk about in the show, which puts us into an environment where value should actually start to do well. Now, if we go back to the old paradigm where 0% interest rates, print money to oblivion, then value is probably not going to be the best place to be because people are just going to buy tech, they're going to buy crypto, they're going to buy anything that can outpace inflation, and they're just going to put their pedal to the floor and go ahead. But if you think that the paradigm's changed like we have, then you should consider value because value will hold up better, like it did in 22, hold up better than growth stocks. Growth stocks will get cleaned out because higher interest rates tend to do better for those kind of value stocks like energy and materials. Just kind of looking through here, financials sometimes. But it depends. If the interest rates, if the yield curve is still negative like it is, the financials aren't going to do very well at all. So you really have to keep in mind, like, are we a new paradigm? And is the old paradigm true? Like the typical value stocks, are those still going to be a good play? Like I said, if we have an inverted yield curve, financials aren't necessarily the best place to be. In our insurance companies, maybe, because a lot of them buy fixed income. And now we have rates of fixed income are pretty decent. So just keep in mind that this new environment that we're in, you have to really stay nimble. And this is the piece that you're not going to really hear anywhere else other than this show, is you have to have agility in your thinking and you have to have agility with your investments. Because if you operate in a box, if your whole world operates in a box, I only do this one thing, that's great if that box works. But what if the box stops working? Let's say your box is the Magnificent Seven, which is whatever they call it, the Significant Six or whatever they're calling it now. They come up with a new moniker every day. But basically the big mega cap tech stocks, if your strategy is only invest in those, then you've done very well over the last, 15 years. Will you do that well in the next 15? I don't know. I have no idea. I can't tell the future. But I suspect that at some point that's going to change, like 2022, where those did not do well. And some of the best performers last year were some of the worst performers the year before. So there will be a time where they won't do well. So are you going to adapt? Are you just going to say, I'll buy and hold and I hope they come back? Hope isn't a strategy, right? You look at Japan, and I'll point out a little tidbit for those of you who are looking for tips and tricks for the week. Look at Japan. Japan has taken 30 years to come back to 35 years, I think, to come back to where they started 35 years ago. 35 years. So if you put all your money in it was January of 1990, you basically lost money for 35 years. Now, I think they've exceeded it now, but it's taken that long to get your money back. Do you want your portfolio to take 35 years to get your money back? Probably not. If you're 25, you're not going to care. If you're 55 or 65, you better damn well care because that's your whole retirement. And how would you like to live off half of your retirement in the next 35 years? I'm not saying it'll happen. I'm saying it has happened in Japan. So there is an example of this could happen, and you should just be aware of it. And you should calculate that in your tolerance for risk. Is this something I'm okay with? If the answer is no, then you need to find another strategy other than buy and hold. And that's the truth of it. If you don't have a strategy other than buy and hold, then you could be setting yourself up for failure. So when we look at those statistics for the large cap, the S&P, especially mega cap, just be aware they're not all on solid footing. 2 of those Magnificent 7 actually came out with good numbers. The other ones, not so much. So are they going to carry us into the next iteration? Don't know, but they've been carrying us so far. So the point of my kind of rant here is just be mindful of what's going on and don't just stick your head in the sand and hope it goes up, because we're not in that environment anymore. And we're at a point where the market's going up and most people will listen to me right now. But if the market drops 10% or 15 or 20%, I guarantee you people are going to say, oh, you're right, let's do that. Well, that's the wrong time to do that. You don't do it after the market dropped. You do it now when the market's up. So if you prepare when the market's up, that is your best strategy. If you're preparing after it drops, it's too late. It's like people who came to me in 2009. They're like, oh, yeah, you had some good strategies in 2008. Can you help me? No, I can't. You've already lost half your money. I can't help you. Like, I can help you get back over time, but I can't help you make it up like you just lost it. No one can. It's impossible. So just be forewarned that if you have, especially if you're getting ready to retirement and you have enough money, don't look for getting 100% returns on your money now. Try to make sure that any returns you get are managed risks so that you're not setting yourself up for failure, which inevitably is going to happen. It could be tomorrow, it could be next month, next year, 10 years from now. I don't know what's going to happen, but it's going to happen. It happens. Economic cycles always do. And so you just need to be prepared for it. Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money. So, Doug, what are some of your thoughts? We got a lot of charts to go through. So, where do you want to start?
Yeah, well, just following up on a couple of things that you were mentioning. I mean, I know someone who just recently decided they're going to make a change on advice that they're receiving. They had a plan that was entirely well structured, ready to retire, but again, they got caught up. They got caught up in the emotions of not getting enough rate of return and wanting to get more rate of return. And even though they didn't need that rate of return in order to be able to achieve the goals that they put out there. And I think this is really important for people who are listening: is know what you want to accomplish, know what matters to you. If what you want to have is something that you can achieve with less risk, then you have to ask yourself why you're taking the risk. And if you've already achieved it, then ask yourself even more so, why are you going to go out and take risks? Because you may, even though there might be that euphoria and greed of being able to get more, if you have enough to accomplish what you already wanted that matters, is it worth putting at risk the fact that you could lose it and now no longer have what matters achievable because of that risk you took? And listen, there is as Kirk's saying, Kirk, you're right. There is no guarantees out there of what's going to happen. There's no way to predict. But in 1 month, just to kind of give some perspective, NVIDIA, for example, gained an entire Tesla in market cap in 1 month. NVIDIA grew by more than the entire market cap of Tesla. Okay. And so you're asking, like, when that chart, I didn't scrub that chart. That chart was posted on February 7th, 2 days ago. So from someone, so obviously there's a little bit of a lag there on it. But we've also got some other things that are very interesting that are just weird right now. And again, none of this is an indicator of what's going to happen. The S&P 500 is what, at least as of 3 days ago, was within 0.35% of a 3-year high. And it's, of course, it's achieved that since then. But fewer than 40% of the stocks that were above their 10-day average, fewer than 60% were above their 50-day average, fewer than 70% were above their 200-day average. The last time it got like this was August 8th, 1929. Okay. So the last time that we've seen those kind of indicators was right before the Great Depression. Now, and the market crash. Now, is that going to happen? The answer to that is, I don't know. Could it? We're also seeing that U.S. equity risk premium, and it basically is how much opportunity are you able to get based on the risk that's in the market right now. It's at a 23-year low. Okay, that the last time it was this low was August of 2000, was just after August of 2000, and it was close. It wasn't even this low in July of 2007. Again, so that's the question: does it make sense to go out and take more risk when you're not necessarily going, when at least the metrics say you're not necessarily getting enough premium to take that risk? It's very similar to the way credit works, right? And it should have. And one of the reasons 2007, and 2008 was a disaster is that because people out there with 400 and 500 credit ratings were getting charged single-digit percent to be able to have the right to have that debt. Well, you can't lend that kind of money out and not get a premium on it for the risk that you're taking. And banks took that. And I think the last thing that I want to just say on this is that it's going to get harder to make pragmatic decisions. Emotion is one of the most difficult challenges that everybody makes when you look at the tea leaves and you look at the data. Okay. And you think, okay, there just something makes sense or something doesn't make sense. Stanley Druckenmiller talked about in the 1999 tech bubble. It went up another 30% after he made a logical decision to go to cash. And he got tired of seeing the stocks up. So he eventually, and this is one of the, one of the great the great investors of the modern time, has basically decided, you know what, I can't watch this anymore. I'm losing money by not being a participant in this. And as soon as he jumped back in, that's when things imploded and he lost $3 billion that year. Now, nobody listening to us, I don't know, Kirk, maybe you do know a few people on this, have $3 billion to lose, but I don't think anybody here has that kind of flexibility that they could come out of losing what Stan lost. The point is emotions are going to get more and more powerful into tempting you to do things that may or may not be what you feel or that the logically makes sense. And that is going to be one thing. I can't tell you how to control those emotions, but understand that when you watch others talking about making money in this, and maybe that is sustainable, and maybe there is a new fundamental paradigm shift, and that, look, this is just going to go on forever. Logically, that doesn't seem to make much sense. Okay, that there's very few things that just continue to go on forever. And again, with risk premiums and things like that, is it, and you see a company take more than an entire company, we talk about the 7, took more than one of the other 7s in 1 month in terms of market cap. Just ask yourself, are you okay playing that risk? Can you afford that risk? And if it doesn't make sense, think about what matters to you and try to ignore the emotion of what others are doing. Because at the end of the day, what they're doing has no impact on you.
So, we called this episode Water Everywhere, Not a Drop to Drink or Invest In. And I wanted to touch on this topic just because I don't want to be that guy. But anyway, I wanted to share this chart, and we came up with this last week and didn't have a time to cover it. But the investing in water concept, we actually interviewed a guest on the show about who was talking about investing in water. And I thought it was a brilliant topic that nobody talks about. I mean, Michael Burry came out with this after the Big Short movie. He talked about how he didn't ever want to take money again. It was a bad experience, and I can't blame him. His investors were, I get it, they're angry, but that's what you get when you invest privately. You're investing in a person. You got to just trust them. However, what happened after is he said, well, he's investing in basically, one resource, which is water. It was kind of the end of the movie. They talked about that. So what I find fascinating is I found this chart, or Doug found it. I can't remember. I think it's probably Doug found this chart, and it talked about the breakup of water on the Earth's surface. It says, where's the Earth's water, for those of you listening. and it breaks it into different categories. So if you look at the categories, the total global water supply, 96.5% is in oceans. 2.5% is freshwater, and less than 1% is other saline type of water, brackish, I assume, kind of things. Now, if you take the freshwater and you break that down, 30% of it's groundwater, 1.2% of it is surface or freshwater, and then 68.7% is glacier and ice caps. Now, if you take the surface and other freshwater, it's broken up between lakes and permafrost ice. So what's interesting is it kind of breaks down where all the water is. And the interview we did talked about how we get more water, right? And obviously you say, well, why don't we just have desalinization plants? Sure, and they burn a ton of energy, which we are in short supply of, right? And people want more green energy, but that's actually a problem. And we're going to have a great guest in the show in the future, which is actually going to talk about a lot of the details, like we talk about in the show, how the clean energy revolution in air quotes is there's a lot of BS built into that. Not to say that the goal is wrong, but the mechanics of it are not as advertised. So we wanted to bring somebody in to really talk about that, to really let people know, like, there are solutions out there, but for whatever reason, we're not pursuing them. And so you have something like, desalinization plants. That's a great source if you could get it to work, but unfortunately, they're energy intensive. So we need another energy source. I've talked about nuclear on the show a lot, and we're going to have more guests to talk about it because it's actually the cleanest, the best energy source that we have. And the reason we're not doing it is because the politicians find it politically unpalatable. They're getting enough money from dirty energy to not go after it. And the public is still scared from events that really didn't turn into big events, right? I mean, Fukushima, yeah, that was bad, but it wasn't terrible. Chernobyl was bad, but that you can blame on a lot of factors which don't happen here. And we had an event here in the U.S. that nobody got killed or injured. So, people are afraid of it, the boogeyman, the nuclear boogeyman. And I think that technology has progressed to such a place where China is going to basically control the world's energy source in the next 20 years because they're building nuclear. They're going to control the technology around it. And we're just deciding, we don't want to touch that. So in the future, we could be relying on other people or our own dirty energy. So I think we're shooting ourselves in the foot by not looking into it. However, I will point out that glaciers and ice caps make up 67%. And of course, we don't want to touch that because the polar bears and Greenpeace, but apparently there's a lot of water trapped in there, which could be an avenue for people to tap into. I don't know if that makes sense. I don't understand the environmental ecosystem. I'm not sure anybody really does because it's so complex, but it's, there are solutions that I think and I point this out in the show for a very specific reason. We as a culture like to talk about things, especially politicians. They like to talk about things, but they don't necessarily like to solve them, because if they solve them, then it's no longer a problem. And then why do you need them? So there's a lot of incentive built into not solving the problem. If you've ever noticed, politicians rarely solve problems. They put a patchwork on it, put a Band-Aid on it, but they don't really solve problems. The private sector solves problems, right? The public sector, they're just like, we'll put a Band-Aid on it. We'll give them some money, have them go away. But if they solve the problem, you don't need them. There was a great line in the movie Wag the Dog, where I think William H. Macy was the guy who was the head of the CIA, and he pulled aside, who was it? I can't remember. I think it was De Niro. Pulled De Niro aside because De Niro was kind of doing this big hoodwink operation. Pulled him aside. He's like, I know there's no war in wherever the heck it was. And he goes into this whole monologue, and it was brilliant. He's like, if there's no war, then why do we need you? And he's like, have a good day, sir. He's like, you're right. Okay, go about your business. So I kind of feel like that's kind of an overlay for what we have to deal with government. So if you look at, and I want to kind of dovetail this into a different topic because we're talking about it, but I want to go back into the markets a little bit because there's some things in here which I think are really important. And we'll get into the energy sector since this is as close as a segue as I could bring it to my other topics. So this is a chart we've Doug found for Microsoft versus the energy sector. So Microsoft's one of the, if not the biggest, I think, are they the biggest company out now, Doug, or has someone surpassed them at the moment?
I have not looked. I have not looked recently to verify that.
$3.1 trillion in market cap is what Microsoft was as of this chart, and we didn't create this chart, by the way. 3.1 trillion in market cap. The S&P 500 energy sector market cap, all of the energy sector, is 1.6 trillion. So Microsoft is 1.9 times bigger, one company compared to the whole energy sector. Now, if you compare the annual cash flow, Microsoft is 67 billion, and the energy sector is 135 billion. So 2 times that.
Hey, Kirk, just to interject, yes, Microsoft currently is largest with based on company's market cap, 3.116 trillion. Apple is number 2 at 2.921, followed by Saudi Aramco at 1.98, and it goes from there. Google's number 4. So
okay, good, thanks, Doug. So if you look at that, it makes you wonder. Now, if I were to buy a company, which one would I buy? Well, assuming the energy sector is a company, just in comparison. So let's use this as an overlay for how to analyze stocks, right? So Microsoft, which great company, and this is not a recommendation, want to be very clear. So you look at Microsoft, great company, right? $3.1 trillion in market cap, cash flow of 67 billion, great company. It's comparatively, we looked at the charts before, like in the PE ratios, it's a little on the expensive side, but they might be worth it. Who knows? But if you compare it to the energy sector, which is gushing free cash flow, it is not necessarily 10% of the market cap, but it's pretty close in comparison to Microsoft, which is, four times less. So when you're looking at investing in a company, try to compare it to other things. Say, and this is really a growth versus value argument more than Microsoft versus the energy sector, because growth versus value typically lines up similarly. So right now, any growth stock is going to be similar to this, where the cash flow is going to be dwarfed by other sectors that are heavily in cash flow, like the energy sector. You look at companies like tobacco, which are just gushing cash flow. You don't have to love them, right? There's a reason why the value stocks tend to do well in a recession. It's the sin stocks: energy, tobacco, gambling, alcohol. Like all those companies typically have good cash flow, especially in recessions. And you look at a company like Microsoft, which has great cash flow, by the way. It's not a knock on them. But there are a lot of companies out there that don't have good cash flow, right? And this is Microsoft. They're actually higher end in the scale when it comes to cash flow. But you look at some other companies, they're just not hitting a home run. They're barely bunting the ball when it comes to cash flow, and yet we value them so highly. So just think about when you're looking at stocks right now. I know it's easy to get baited and want to jump in and buy all these stocks because they're climbing higher. And I'm not saying don't, because it wouldn't be a bad idea to have exposure to them right now. But let's look at that in comparison to copper futures. Now, copper is what we would call Dr. Copper. I didn't come up with this name. This has been a Wall Street name for a long time. But people call copper prices Dr. Copper because copper typically is an indicator of the future direction of the stock market. Now, if you look here, and once again, I'm going to pull a chart crime on myself and show that this is only a few months. And so, this is a little bit misleading. I want to be very clear, a little bit misleading because of the short nature of the chart. However, if you look at long periods of time, there is a pretty strong correlation between the direction of copper prices and the direction of the index. So this is more illustrative. Do not take this as word because, like I said, it's a chart crime in itself. But it is something you should acknowledge, that when copper starts to decline, it usually means that there's fewer people buying copper, which means that the basics of the economy are not growing, which I think is indicated in both the earnings and the stock prices. But and by the way, copper prices could decline for other reasons. But it's one of those materials that is in everything. Everything requires copper. So if you have copper prices that are declining, it means that the general overall economy is not expanding. Now, if copper prices are increasing, like the end of last year, you could say, all right, well, this is a good sign. So just another indicator to be aware of. That's you should watch. I think it's not just now; it's over long periods of time. Is a great indicator to look at. And I wanted to point out, let's see, one more thing, and I'll let Doug get into real estate because we've got a ton of real estate charts here.
While you're looking that up really quickly, I just want to say, really interestingly enough, the number one earnings company in the world, Saudi Aramco, 247 billion. That is more than the next three to four combined. So Apple, Berkshire Hathaway, Microsoft, and Alphabet, and the largest revenue company in the world is still Walmart. It's crazy, 638 billion in revenue.
Yeah, I mean they sell real stuff and they do it at volume. All the power to them. I mean, Amazon does the same thing. They sell real stuff. They do it at volume. They've definitely it's more technology based, which is obviously directionally where we're going. But people still shop at Walmart. They're not going to buy a couch on Amazon. Oh, actually, I don't have a picture of this, but I found something on social media last week. Did you know they sell houses on Amazon, Doug? Not the kind that you and I live in, the kind that show up in a box. So there's have you
Sears
seen
Roebuck started that, 50, 80 years ago. It's like, I feel like history, when people talk about history is not important, it repeats itself. If you can go back, search on the internet, you'll find advertisements of Sears Roebuck selling homes in the 1940s. Now, they didn't come in a box. So welcome to the IKEA of everything. You'll have to assemble it yourself.
Yeah, and I'm going to put a picture in the show notes because it's hilarious. I saw this the other day, and it's a video of a mini house showing up in a oversized Amazon box. I mean, it's hilarious. It just had the cardboard box around it, but it's basically a home that's compressed, and you can walk in it, and you have to open it up. So you have to like push it out, and it'll expand to 3 times the size of what shows up. But it's just so cool that like you can get a home. I think it's like 200-300 square feet. It's not big, right? But for some people, like if you wanted to put that on the side of a mountain, that'd be pretty cool, right? You got your own portable home you can put anywhere. You can't build a house there, but you can have it shipped. Amazon will drop ship it with their drones or whatever they're going to do. But point being is things are changing rapidly, and we need to be aware of it. All right, so 2 more charts. We'll get into I'll let Doug do the housing, and we'll kind of move on here. So one thing I want to point out is another indicator, and you should also note that I'm pointing out bearish indicators to be a contrarian. There's plenty to look at when you want to look at bullish. I don't think you need to hear that from me. Like if you want bullish, I'll just show you the stock price of the S&P 500. That's bullish, and that is the biggest bullish indicator you can find. Look at the stock prices. A stock price going up is bullish. A stock price going down is bearish. The S&P 500 last night broke above 5,000.
Correct.
And I think at the close it did by like 10 cents. And then today it kept going. So people are assuming that they're leaving 5,000 in the dust. And that is a bullish sign if anything is. So I wanted to mention that too, because I want to talk about both sides, not just one. But I do want to share this chart, which is insiders are selling out of the market at an astronomical ratio. Now, I want to point out one thing in this, is that this is frequently a chart which I would put in the chart crime territory. Now, here's why. When people show you, historic highs of insider selling, let's look at insiders. Now, they're typically like a CEO, right? And you think a CEO knows exactly what's going on. Okay, CFO more so, because they know where the numbers are. So if you see a CEO or a CFO selling, you might think, oh my God, the stock's going to crash. Well, hold on. Don't rush to sell. Don't hit the sell button yet. Here's the reason why they could be selling. They're buying a new home. They're getting divorced. They're buying a car. They're buying another company. They're diversifying. Could be 50 million reasons why they're selling. And we don't know that. right? So some CEOs just sell periodically. Every year they sell a portion of the shares. And that's okay, right? That's their prerogative. They have the shares, it's theirs to sell. Now, if they're buying, there's only one reason why they'd be buying. And the reason is they like the price of the stock and they like the direction. So insider buying is a really hot indicator you should look at. Insider selling, you can kind of overlook it. It's a nonsense indicator. It's noise. But this is not nonsense. This is holy crap. Janie bar in the door. This is 4 times the previous highs of last year. This is wow. People are deciding to sell. Now I will point out, in all honesty, this is the last 12 months. So, you take that with a grain of salt too. But if you're looking at just a normalization of where it was, it's a lot higher. If you look at this historically, it's probably not going to be crazy, but you should be aware of it. A lot of CEOs have decided, hey, now's a good time to free up some cash, so I can keep that in the sidelines for some future date. Doug, you want to talk about some home prices and mortgages before we wrap it up?
Yeah, I also want to add one last thing, because I'm glad you addressed that. It has been a much better indicator to look at insider buying, but also note that chart shows January 2024. But what we don't know is where that line was spiking, if it spiked into January 2024 or if it was spiking in December. It could be there is a lot of tax planning that's going on there that in reasons.
This is January 15th. That's
was
the date.
Well, the date of the chart, but again, I don't know necessarily when all of those sales were occurring. Were they occurring in December? So there's a lot more to it. You really need to. I'd want to get down into the micro details of where the data points came into that chart to have a little bit more clarity. But it is a significant spike, and it is definitely, again, as we always say, it's not predictive, but it's definitely worth watching. We wanted to talk about real estate. A couple of things that I thought really interesting, and it kind of, again, for the sake of time, I'm going to go kind of fast on this. I think it's no surprise to everybody that the affordability index for real estate has significantly dropped, as not only we have continued to see a very stale transactional market in the housing market as well. Kind of availability is still not there. So what is available, supply versus demand, and then we add in the interest rates, and we take you take a look at the breakdown that's coming into that chart. Again, it has been a sharp decline of affordability since roughly January 2021, and some of the worst affordability that has since 1986-ish. We are now at that metric. So it is definitely harder, very much a more difficult achievement to be able to buy into housing. So it's not surprising me that when you come to the survivability of what's necessary, food, clothing, water, shelter, any shelter is going to help you survive. It may not help you survive in comfort. It may lead to mental health issues, which may not help you to survive. But at the end of the day, keeping shelter from the elements. So it's not surprised that you're starting to see things like, people get creative in adverse situations, while you're seeing, being able to buy a house shipped from Amazon. The other thing too is, again, that supply. There is plenty of places that people can move. If I don't have the map in front of me, but we are still seeing housing really be, a little bit more challenged in some of the coastal areas, although mainly a lot of more of the South and Southwest. A lot of the Midwest and where you are, Kirk, in New England is actually doing better. By the way, long term, as we talk about water, just want to say that the Great Lakes hold 21% of the world's surface freshwater. So, you have to look at, when we talk, about the United States and some of the things that, all the bad that we've got going on, there's a lot of things the United States just positioned wise globally in the planet, the resources that we have had and continue to have. We're now producing more oil again, even though Saudi Aramco, number 3 in revenues, number 1 in earnings. Obviously, it's still a major source of oil. We are still a major producer of oil, raw materials, access to water. But I wanted to point out that GDP, interesting. I think it's really important because when we think about housing, we think about where the jobs are and where they're being produced. The GDP of the United States is real. And I think this is really interesting from a political spectrum. Look, I don't know if you want to pull that up, Kirk, but if you really look at where the production is in the United States, it is really located in probably in about a handful of about 13 different places in the United States that make up 50% of all the GDP produced within the United States. The rest of the country makes up the other 50. That is something that is incredibly important to note, not only because of where that means that housing needs to be and where it drives housing prices and where the concentration is based on jobs and production. Now, what's that going to mean as we continue to see this kind of this stretch and pull as to, whether or not people are going to need to come back into the office or going to be able to work more remote, how that might shift some things is going to be very interesting. But look at the impact there. And it's the major cities that are driving a huge impact on both GDP and a huge impact when it comes to the balance of political power. I find that one to be a very interesting breakdown. The other thing that looking at regards to real estate is one of the things that we're still facing is that Americans are sitting on a tremendous amount of equity. 67.4% of Americans have paid off their mortgage or have at least 50% equity. So we're not only talking about interest rates people are paying on and what interest rate that would now become if they moved and what they would have to take out in a new interest rate, which certainly is going to keep people hesitant on selling the home that they're in. But also the fact that many people, 3/4 of homeowners are actually, either free and clear or have less than half left, which, by the way, if you think about amortization schedules, by the time you get half of at least 50% equity, or at least half of your mortgage paid down, you start to get into where it's just principal. You're not really paying near as much interest anymore, which of course makes resetting the clock and deciding to sell, a very important factor in the decision making. I believe, I don't know if you had this, Kirk. I don't know if we have a chart for it, but there was a chart, and maybe it's something I found separately, but a lot of people are ending on number one reason that a lot of people, and predominantly boomers, are moving, especially over 100 miles, is that they are moving to be near family. So ultimately, where the next generation tends to settle is one of the number one variables that is causing homeowners to look to sell, is to now move to where their next generation has been located. So there's a couple of things, there. I think another one that I want to note is where is the risk? We talked about in the last couple of weeks, banks and the stretching of banks in terms of where they are exposed. The biggest predominant, the biggest impact is going to be on small banks. So if we there was a chart, if we look at large commercial banks, only 7% of the loan of the assets that they have is in commercial real estate. Over 30% of the assets of small commercial banks is in commercial real estate. So that's a significant exposure. Clearly, the large commercial banks have a larger exposure to residential real estate, which isn't in near the same type of it doesn't have near the same type of headwinds as commercial real estate is. And the bigger banks are tending to get more and more out of lending in general. There's a couple other charts that kind of show the impact of the different how much large commercial banks have an exposure to ultimately loans as a percentage of assets total. It's been declining. So if we go back into the 1980s, it was roughly in the 60 to 65% for large commercial banks. Now, as a percentage of assets of loans, it is now down to about 49%. It actually was for a while there as low as 45%. You look at small commercial banks, the percentage of loans is as high as 68% and rising. So back in the 1980s, it was only 50%. So they're relying a lot more on loans as a source of their revenue and their assets, which of course is why we have Janet Yellen now coming out, whether or not you believe what's being told or not. She is actually just came out and warned of potential bank failure of non-bank mortgage lenders. Non-bank mortgage lenders actually account for 51% of funded mortgages as of 2022, and they are not eligible for the Fed's emergency lending facility, which we've talked about in several weeks, was basically the lending facility that was set up to help with the reserve requirements and liquidity issues the banks. So of these banks out there, they do not have any excess liquidity or any source of liquidity that they can turn to in order to help them if they come into a liquidity issue. So the fact that that's 51% of all funding mortgages out there, that is definitely another metric to note. And again, we're not being bearish here, to sound like doomsayers, but it is important that we are you're looking at those things as a counterbalance, as like Kirk said, to the fact that the S&P 500 is up another banging percent as the last time I looked today. We are seeing commercial real estate delinquencies are continuing to rise. That is, certainly, again, something that most people by now that might be listening know. Commercial real estate is under a lot of pressure. We are seeing that from a delinquency standpoint, year to year change. We are at the same level that it was right about 2019, which is the second highest level that we've seen since 2007. Now, it's nowhere near where 2007 was. So it's not like we're on the cusp of the exact same thing. We have different metrics and different scenarios occurring today that obviously make what is going on with that exposure of banks different than it was at that time, which of course is going to help to ease some of the immediate concerns that may be out there. But it definitely, we're starting to see that rise, and that exposure to those loans and exposure to those delinquencies, again, there's a contagion effect that can actually come if all of a sudden these things start to, dominoes start to fall. Last thing, again, it's a projection. Again, this could be considered a chart kind, but if you look at the steady decline, we've talked about excess savings out there. How is people still looking? You look around, so how are people able to spend? Well, some of that is credit and some of that is savings, and there is still surplus savings. But you go back to 2021, surplus savings was about $2.1 trillion, and it has steadily, and I mean steadily, declined, not with any sharp declines. It has been steadily going down ever since, and as of right now, we're looking at right around maybe 0.4 trillion. So 400 billion. And if we follow that trend line, and if it does continue to follow the same path, we're looking at, possibly March of this year is when we're finally going to see that overall savings could be down to nil. And if that's the case, it'd be good to watch after March. What do we start to see in terms of any additional changes with regards to credit and credit cards and other types of lending out there? Are we starting to see a spike in it? Because if so, it's going to definitely represent a greater level of clarity as to how homes are feeling. Last thing I want to say, because I know we're actually over time. Geez, time flew away on us. We'll talk about this next week. We've got a chart we'll get back to. Obviously, I'm in college planning. ProCollege Planners, because I know Kirk's going to ask me where I can find more about me. ProCollegePlanners.com. If you go out there, you can get some really good information on what you need to know before you get into college planning, especially if you have a kid that's in high school. It's never too early to look at this, but if they're a sophomore in high school, you have to be looking now, especially a sophomore or later. Get the information before you dig into it, before it's too late, before they tell you what you have to pay. You can find out how to get the cost down. But the biggest thing that we're seeing in the last note on that I was going to pull up is Americans' confidence in higher education continues to fall. 2015, people, based on survey about whether or not it was a great deal of confidence versus little, 28% said great deal, 33% said some, 9% said very little. As of 2023, only 8 years later, 22% of people polled feel that higher education, they have very little confidence in it. So 40% have some. We've dropped from 28% to 17% for great deals. So there's definitely a shift in how people feel. And a lot of that has to do with your return on your investment, how much you're paying for college, and what are you getting for it. And a lot of the news lately with the presidents of some of these institutions. Again, go to our website, ProCollege Planners, learn more. Thanks, Kirk.
Great.
Sorry.
No, thanks for coming on, Doug. And yeah, I'm glad we get to share that. I'm sure it's no surprise to anyone that people are losing confidence in colleges. Just the nature of, I think when they were in front of the was it 3 or 4 presidents were in front of Congress, and they look like Larry, Moe, and Curly up there. The way they were presenting themselves was a little bit. I'm still speechless that their PR people should be fired. I guess they themselves were fired, but their PR people definitely shouldn't find work again. It was a horrendous way to address certain questions. I do want to point out one thing as we wrap it up, and I pulled this up today. I was looking at this because somebody had asked me, "Oh, what do we do if we want bonds at a longer rate?" Now, I point this out because if you look on this chart, if you can see it, on the far left is the short end of the curve. That's like basically instant money, like money market kind of thing. Then it goes to 1 month, 2 month, 3, 4, 6, 1 year, 2 year, 3 year, and it goes all the way up to 30 year. This is effectively the yield curve. So when people talk about a yield curve or inverted yield curve, this is actually the current yield curve for the U.S. Treasuries. So the red one is October 19th, and that was actually an inflection point, which I have it here, and the blue one is today. So if you notice, the blue one is heavily inverted. At the front end, you're like 5.3. On the long end, you're like 4.38 or something like that. That's a pretty big inversion, and it hasn't been changed all that much in the last over a year. It's been actually a long time. And so what's interesting is if you look back, if you wanted to get 5%, well, right now you're looking at 9 months, you can get 5%. But if you look back a few months ago, back in October, you actually could have got 5%, more than 5% out in the 30 year, the 20 year, you could have gotten 5.3. So, I mean, right now, 20 year 5.3 paper looks pretty attractive, right? Now, if interest rates go up to 15%, it won't look attractive at all. But for the moment, it looks attractive because rates are a lot lower, and they probably will remain lower. I don't see inflation ticking up unless Biden decides to treat Mexico, Iran like Mexico, or Mexico like Iran, or whatever that gaffe he made the other day. I think the reality is that if the Middle East blows up and really turns into a crapshoot of whatever's going to happen, then inflation could go through the roof. Shipping costs will go up and all that, as they seem to be. So we could be headed for higher inflation. I don't think we're headed for the 70s style inflation where you had those oil spikes, but it could happen. I mean, the world's in the same place where it's touch and go. Anything could happen. Global conflict could happen around every corner, and nobody wants it. I just want to be clear. I don't think Russia wants it. We don't want it. China doesn't want it. Nobody wants global nuclear conflict. But because of the nature of the world and the instability, it is happening. So just keep an eye on the yield curve. There could be a time where you could lock in some pretty good rates for a long period of time. Right now, I wouldn't say is that time, but we're not giving you investment advice. So we're going to wrap it up for the show this week. We'll come on next week, and we got tons more charts. I think what's interesting about the markets right now is the relentless support of buyers under the market right now. And when, as Doug said, you have people like Stanley Druckenmiller, who came out and pretty much said, "Yeah, I made this mistake in the '90s, and I'm not doing it again." I.e., what he means is, you guys are all crazy buying this market. So we'll talk about that a little bit more, about how you can buy in the market and make money, and at the same time protect yourself. But we'll save that for next week. So that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.